Hello everyone, and welcome to this video on the Capital Asset Pricing Model, or CAPM. In this video, we'll discuss the basics of CAPM and how it can be used to calculate the expected return of an asset. So, let's get started. What is CAPM? CAPM is a model used to determine the expected return on an asset based on its risk and the risk of the overall market. It was developed by William Sharpe, John Lintner, and Jan Maassen in the 1960s. Why is CAPM important? The purpose of CAPM is to help investors make informed investment decisions by calculating the expected return of an asset. It provides a framework for understanding the relationship between risk and return, and it is used by many investors to evaluate the risk and return of different assets. How does CAPM work? The CAPM formula can be broken down into three parts. Risk-free rate. The first part of the formula is the risk-free rate, which is the rate of return that an investor can earn with no risk. This is typically the rate of return on a government bond. Market risk premium. The second part of the formula is the market risk premium, which is the difference between the expected return on the overall market and the risk-free rate. Asset beta. The third part of the formula is the asset beta, which is a measure of the asset's risk relative to the overall market. CAPM formula. The CAPM formula is as follows. Expected return equals risk-free rate plus asset beta x market risk premium. How to calculate CAPM? Now that we know the CAPM formula, let's take a look at how to calculate it. Determine the risk-free rate. Determine the rate of return on a risk-free asset, typically a government bond. Determine the market risk premium. Determine the difference between the expected return on the overall market and the risk-free rate. Determine the asset beta. Determine the asset's beta, which is a measure of the asset's risk relative to the overall market. Plug in the numbers. Plug in the risk-free rate, market risk premium, and asset beta into the CAPM formula to calculate the expected return of the asset. Limitations of CAPM. It is important to note that CAPM has its limitations. Some of these limitations include assumptions. CAPM is based on certain assumptions, such as the assumption that investors are rational and markets are efficient. However, these assumptions may not always hold true. Simplistic model. CAPM is a simplistic model that does not take into account all of the factors that may impact an asset's expected return. Historical data. CAPM relies on historical data to calculate the expected return, which may not always be indicative of future performance. In conclusion, CAPM is a model used to determine the expected return on an asset based on its risk and the risk of the overall market. It provides a framework for understanding the relationship between risk and return, and it is used by many investors to evaluate the risk and return of different assets. Thank you for watching this video on the Capital Asset Pricing Model. If you have any questions or comments, please leave them below. And don't forget to like and subscribe for more videos like this.